Hello world, welcome to Farm the Market. Whenever a company decides to take the huge step of going public, it gives the investment community a chance to own a fraction of their business. Nowadays, a lot of market participants just think of stocks as tickers that move up or down in a chart, but it's important to remember that whenever you buy or sell a stock, you are buying or selling a part of a company. But where do these shares come from? When a company goes public, it must define the maximum number of shares it can legally issue. This is specified in its articles of incorporation. The maximum number of shares it can issue is known as the Authorized Shares. For this video, we will focus only on the common shares. Think of Authorized Shares as the main set that defines the universe of the company's shares. Every other type of share, including outstanding shares, is a subset of the Authorized Shares set. When an initial public offering takes place, the set of authorized shares is divided in two subsets, issued shares and unissued shares. When a company is in the IPO process, it will define how many shares it wants to issue, therefore defining how much of the company will be available to the public. Unissued shares are self-explanatory. They simply do not circulate. The companies don't even print up certificates for them. Unissued shares don't have voting rights nor receive dividends. Therefore, they are pretty much irrelevant to the investors in the present. However, it's important to consider that they do represent the potential risk of future dilutions. Issued shares is a subset of authorized shares that circulate in the market. Issued shares are divided in two subsets, treasury shares and outstanding shares. Treasury shares are issued shares that the company owns itself. It might sound weird that a corporation owns itself, but there are a couple of reasons why this might happen. Maybe the company was not able to sell all the shares it intended to in the IPO, so they hold back some shares for future use. Another reason is stock buybacks. We will review stock buybacks in detail in a future video, but for now, let's just say sometimes it's convenient for a company to buy back its own shares. It's important to mention that treasury shares do not have voting rights nor receive dividends. Outstanding shares is a subset of the issued shares that are held by all market participants in the open market. These participants may include company executives and employees, institutional investors, and retail investors. These shares have voting rights and receive dividends. Outstanding shares are also important to consider given they are the ones used to calculate important metrics, such as earnings per share, cash flow per share, and the market capitalization of the company. It's also an important number to track over time to determine if the company is diluting or rewarding long-term investors. As you might expect, outstanding shares are also divided in two subsets, restricted shares and float shares. Restricted shares are the shares held by executives, directors, employees, or any other person related to the company that has a legal limitation and is not free to sell or transfer the shares. For example, a lock-up period or a limitation as part of a compensation plan that applies only if the employee continues to work at the company for a determined period of time. As part of this subset, we can also count closely held shares. These basically refer to shares held by insiders or big blocks held by institutional investors that even they may have no legal limitation to sell, they are not likely to do so. Finally, the float. Basically, the float is the shares outstanding minus the restricted shares. These are the shares available for the general investing public. The float is relevant because it's the actual number of shares available to be bought or sold by the average investor. It gives you a good idea of how liquid a stock is. Good liquidity usually implies a narrow bid-offer spread and makes the stock more appealing to investors and traders. You may be wondering, where can you find all this information? Well, strictly speaking, all the information regarding stockholders' equity can be found in the balance sheet of the annual or quarterly reports of the company, also known as 10K or 10Q respectively. For example, Here you can see an extract of Apple's 10Q for the quarter ending in March 2020, before their latest stock split. The number of authorized shares was 12.6 billion. A few months later, they announced a 4-for-1 split. So even this had no dilution effect on the stockholders, they had to increase the number of authorized shares to accommodate the split. So, now if we look at an extract of Apple's latest 10Q, we can see that the number of authorized shares is 4 times what it was before the split, 50.4 billion shares. Although I recommend that you familiarize yourself as much as possible with the company filings in the SEC website, there are many websites available that can give you a summary of the main indicators you are looking for to get a general idea of the status of a company, including their shares distribution. A simple web search will show you lots of free and paid alternatives to review a company's numbers. If you found this information useful and interesting, please don't forget to like this video. If you haven't already, I invite you to subscribe to the channel and turn on notifications so you don't miss future videos. Remember that everything presented here is for educational purposes only. Thanks for your time.